Something strange is happening right now under the cover of darkness. While you're sleeping, a massive secret operation is unfolding. We're talking about armed trucks, private cargo jets with no markings, and huge wooden boxes filled with something valuable. But these boxes have serial numbers with no company names on them. Check the official data from the U.S. Geological Survey or Swiss Customs records yourself. You'll notice something weird, a massive, sudden jump in physical gold leaving Western countries and heading east. This isn't normal business trading. This is an escape plan. The world's richest people, billionaires, powerful families, and government investment funds are pulling their wealth out of the famous vaults in London, New York, and Zurich. They're moving their treasure to safety. They're re-putting all their physical wealth in the one place they think will survive when the global debt system crashes. And that place? Singapore. Why has this tiny island city suddenly become the world's most trusted vault? To understand that, you need to see why the old safe places are dying. For 100 years, wealthy people followed one simple rule: keep your cash in New York and your gold in Switzerland. This worked because everyone believed America protected your property rights and Switzerland stayed out of politics. But over the past 3 years, both of these beliefs have been completely destroyed. The US dollar became a weapon. When America froze $300 billion of Russian money in 2022, it sent shockwaves through every billionaire on Earth. Shockwaves we're still feeling today. What did this prove? Simple. If your money sits in a Western country, or any country that follows Western orders, you don't really own it. You're just borrowing it. And that permission can disappear instantly if you end up on the wrong side of politics. Switzerland, the gold standard for privacy and staying neutral, destroyed its own reputation with the ultra-wealthy when it broke 200 years of tradition. They joined the EU sanctions against Russia. This was the breaking point. For Chinese billionaires, Saudi princes, and libertarian tech billionaires, the message became crystal clear: Swiss vaults aren't safe anymore. If Washington says, hand it over, the Swiss will unlock the doors. Swiss banking privacy, which was already weakened by 2010's laws, was finally dead. The vault might be physically secure, but the legal protection of the country was compromised. The political risk of keeping gold in Europe or America had become deadly. Enter Singapore. While the West was turning its financial system into a weapon, Singapore was quietly building the infrastructure to become the Switzerland of Asia. But a Switzerland that actually keeps its mouth shut and its vault doors locked. The main location for all this incoming gold looks like something from a science fiction movie. It's called a free port. Sitting right next to Changi Airport, it's a super high security compound that operates as a special free trade zone. Here's the clever part. Gold stored there technically has entered Singapore for tax purposes, but it gets full protection from Singapore's powerful police force. It's a legal loophole. But more importantly, Singapore as a country has firmly refused to take sides in the new Cold War between superpowers. They're friendly with both America and China. They've clearly stated they won't enforce one-sided sanctions unless the UN Security Council approves them. Since the UN Security Council is stuck in deadlock with vetoes, this basically means Singapore is sanction-proof. The billionaires moving their gold, they aren't doing it for profit. Gold doesn't pay interest. They're doing it for control and protection of their wealth. There's another sneaky reason for moving to Singapore: the physical reality of the gold market. The Western gold market, London and New York, is mostly a paper market. For every actual ounce of physical gold sitting in COMEX vaults, hundreds of ounces of paper gold get traded every day: futures contracts, unallocated accounts, ETFs. It's a fractional reserve system, just like banks. If everyone demanded their actual metal on the same day, the whole system would explode. There isn't enough gold to go around. The billionaires know this secret. They know that when the great default happens, the paper gold market will break. The ETFs will give you cash, not metal. You'll get a check for what the gold was worth, but you won't get the actual gold. And that check will be in dollars that are losing value. The Eastern gold market, Shanghai and Singapore, is a physical market. Contracts are settled with actual metal. The gold bars actually move. The ownership is real. By moving their gold to Singapore, these investors are escaping the fractional reserve casino of the West and entering the fully backed reality of the East. They're demanding allocated, segregated storage. This means their specific gold bars with their specific serial numbers sit on a specific shelf that belongs only to them. It's not on a bank's balance sheet. It's not someone else's liability. It's pure property. The huge amount of metal moving east is creating a shortage in the West. This explains the price gap we're seeing. Physical coins and bars are selling for way more than the spot price you see on TV. The spot price is the price of paper gold. The premium is the cost of getting real gold. That premium is the market whispering that supply is running low. The refineries in Switzerland, Vocambi, Pampay, Arger Heraeus are running around the clock, but they're not refining for European banks. They remelting down 400-ounce delivery bars, preferred by Western central banks, into 1-kilo bars, preferred by Asian investors, and shipping them to Singapore and Shanghai. This melting and recasting process is physical proof of the wealth transfer happening. The gold is literally changing shape to fit the preferences of its new owners. This migration also signals a huge bet against the US dollar system. You do unmove 10 tons of gold to Singapore if you think the US economy is about to boom. You do it if you think America is entering a period of chaotic decline, capital controls, and wealth taxes. The Singapore Fortress is the insurance policy against American collapse. These billionaires aren't preppers in the sense of digging bunkers in their backyards, though some are doing that too. They're financial preppers. They're making sure that when the SWIFT payment system gets weaponized against regular people, when capital controls stop you from sending money out of the country, their wealth is already safely on the other side. They're getting ahead of the Iron Curtain closing. The silence around this movement is intentional. If you're moving $1 billion in gold, you don't announce it publicly. You don't want the market to get ahead of you. You don't want the government to notice. You hire private security companies. You use private airstrips. You use shell companies. But the flow of metal is too massive to hide completely. Shipping insurance premiums are rising. High-security vault space in Singapore is disappearing. Wait lists for private vaults at Le Freeport are now months long. This is the warning sign. When the smartest, best connected, and most paranoid money in the world is physically running away from the Western banking system, you should pay attention. They're seeing something on the horizon that the stock market hasn't priced in yet. They're seeing the end of the trust-based money system and the return to a collateral-based system. And in a collateral-based system, possession isn't 9/10 of the law, it's everything. If you don't physically hold it, you don't own it. And if you hold it in a country that hates you, you don't own it either. Singapore is the last neutral ground. It's the final safe place where the old rules of property still work. And the door is closing fast. If the why of the gold migration is the collapse of Western property rights, the how is a specific advantage that Singapore offers that doesn't exist in New York, London, or Zurich. To understand it, we need to destroy the illusion of safety that 99% of investors trust. The gold ETF. When you buy shares in GLD or SLV, you don't own gold. You own a trust unit that has a claim on a custodian, usually a bank like HSBC or JP Morgan, to hold gold for you. You're not an owner, you're an unsecured creditor. In a sovereign debt crisis, this difference is deadly. The legal documents of major gold ETFs contain emergency clauses that let them pay you in cash if the physical gold is unavailable due to government action or delivery failures. If the U.S. government decides to take gold like they did in 1933, they won't knock on your door. They'll simply order the ETF custodians to hand over the metal. Your ETF share price will freeze and you'll get mailed a check for the official price of gold, which will be way lower than the street price. The billionaires know this. They know that paper gold is a bet on the very system they're betting against. To bet against the system, you must be outside the system. This brings us to the Singapore solution. The genius of Singapore's approach is they created a legal category called Investment Precious Metals, IPM. The process has been modernized for the digital age. You don't need to fly to Singapore with a suitcase. The smart money uses allocated segregated storage. This is the most important term you'll learn today. Unallocated storage, what most banks offer, means you have a claim on a shared pool of gold. If the bank goes bankrupt, you're just another creditor fighting for scraps. Allocated storage means specific bars with specific serial numbers are registered in your name. Segregated storage means those bars are physically separated from everyone else's assets, often in a sealed box or on a dedicated shelf. In Singapore, you can open an account remotely, wire money, and buy physical bars that immediately go into your segregated vault. You get a title deed or warehouse receipt. Crucially, because this is a bailment relationship, not a deposit, the vault operator cannot lend out, lease, or rehypothecate your gold. Even if the vault company goes bankrupt, your gold isn't part of their assets, it's yours. You can walk in and take it. The system depends on the chain of integrity. When you buy a gold bar in Singapore from a trusted dealer, it comes straight from a good delivery refiner like Pamp Suisse or Volcambi. It enters the vault without ever leaving the secure logistics chain. This guarantees that when you eventually sell it, you get full market price because the authenticity is guaranteed. If you buried gold in your backyard in Ohio and tried to sell it 10 years later, you'd have to pay for expensive testing to prove it's not fake. In the Singapore system, the chain of integrity maintains the ease of selling the asset. You can sell your bars back to the dealer instantly with a click, getting your money in minutes. It combines the ease of an ETF with the legal safety of physical ownership. For regular investors who aren't billionaires, this system is surprisingly accessible. You don't need to buy a 400-ounce good delivery bar, which costs roughly $1 million. The danger, of course, is capital controls, getting the money there. The window is closing because Western banks are making it harder to send large amounts to Singaporean gold dealers. They'll flag the transaction. They'll ask for proof of where your money came from. They'll delay the wire for weeks. This is the soft capital control we discussed before. The billionaires moved their money last month because they sensed hard capital controls are coming. They moved before the wire transfer window slammed shut. If you're sitting in the US or Europe thinking, I'll do this later, you're missing the point. The exit door is only an exit if you can get through it. Once the crisis starts, the door becomes a wall. In the next section, we'll discuss the digital twin revolution happening. In Singapore, how gold is being tokenized on the blockchain to let it be spent like cash, effectively creating a new gold standard parallel to the dying paper money system. The billionaire migration to Singapore isn't just a retreat into a physical fortress. It's a forward move into a new money system. While moving heavy wooden crates provides deep storage security, it has one fatal flaw that's plagued gold for a century: utility. You can't use a gold bar to pay a supplier in Vietnam for electronics. In the modern world, money must move at the speed of light, or it's not money, it's just a museum piece. This liquidity problem is what allowed paper dollars to conquer the world. But in Singapore, the concept is simple but legally revolutionary. When you deposit physical gold into these advanced Singaporean vaults, the vault issues a digital token on a blockchain like Ethereum that represents legal ownership of that specific metal. This token is the digital twin of the physical bar. If you own the token, you own the gold. If you send the token to someone else, legal ownership of the gold instantly shifts to them without the heavy bar ever leaving the vault. This creates Gold Standard 2.0. It allows gold to be sent anywhere in the world, 24/7. For pennies in transaction fees, bypassing the SWIFT system, U.S. banking blockades, and the watching eyes of Western regulators, it turns a store of value back into spendable money. This technology is a nightmare for the U.S. Treasury. The power of U.S. sanctions depends on the ability to choke off dollar flows. If Iran wants to sell oil to China, they historically had to use the dollar system, which meant the U.S. could freeze the trade. But if China pays Iran in tokenized gold backed by metal sitting in neutral Singapore, the transaction is invisible to New York, no banks involved, no SWIFT codes used. Settlement is instant and final. The digital twin creates a parallel trade system that's immune to geopolitical weaponization. This isn't theory. It's already happening. The volume of tokenized gold transactions is exploding as bricks. Nations and global South merchants look for ways to settle trades without touching the toxic US dollar. They're using Singapore as the trust anchor where the metal sits, and the blockchain as the transport layer where the value moves. For individual investors, the digital twin offers a specific advantage, the ability to be unbanked but liquid. In the past, if you wanted to exit the banking system, you had to withdraw cash, risky, loses value, or buy physical gold, hard to sell quickly. Now you can hold your wealth in tokenized gold. You're effectively betting against the dollar and holding real assets, yet you keep the ability to spend. Debit cards are being issued by these fintech vault hybrids that let you spend your gold tokens at stores. When you swipe the card to buy groceries, the system sells 0.01 grams of your gold, converts it to paper money instantly, and pays the merchant. You live your life on a gold standard. While the rest of the world drowns in paper money inflation, you're opting out of the currency debasement. Every day you hold a token, your purchasing power is preserved or rises. Every day your neighbor holds dollars in a bank, their purchasing power bleeds away. This technological leap also enables the Lombard credit strategy for regular people. Historically, only the ultra-wealthy could borrow against their assets to avoid selling them. If a billionaire needs cash, he doesn't sell his stocks, he borrows against them. Now, using DeFi, decentralized finance, protocols connected to these gold tokens, you can be your own central bank. You lock up your gold tokens as collateral and borrow stablecoins, digital dollars, against them at 3% or 4% interest. You use the borrowed cash to pay living expenses. You never sell the gold, so you never trigger a capital gains tax. If gold doubles in price over 5 years, your net worth doubles, and the debt becomes easier to pay off since you're paying back in devalued dollars. This is the buy, borrow, die strategy democratized. It lets you use your wealth without selling it. It's the ultimate financial hack for the difficult decade ahead. However, a critical distinction must be made between true digital twins and paper tokens. Not all gold tokens are created equal. Many popular crypto gold tokens are just claims on a trust, similar to an ETF. They're unallocated. The Singaporean model pushes for detailed allocation. This means the token is tied to specific batches of bars. If the blockchain says you own token number 8994, and the vault audit says token number 8994 corresponds to bar serial number 2255, you have a direct property link. To verify this, the best vaults use proof of reserve technology. They have cameras and sensors in the vault that update the blockchain in real time. You can log in and see a photo of your specific gold bar. This transparency kills fractional reserve fraud. You know, your gold isn't being lent out to 5 other people because the blockchain prevents double spending and the physical audit proves it exists. This is the solution to FTX-style crypto frauds and Wall Street rehypothecation games. The battle for the future of money will be fought between 2 digital giants, CBDCs, central bank digital currencies, and asset-backed tokens. The CBDC is the tool of the state. It's programmable, surveillance-based, and inflationary. The government can turn it off if your social credit score drops. It's a digital prison. The asset-backed token, gold, Bitcoin, is the tool of the free individual. It's private, bearer-based, and deflationary. It's digital freedom. Singapore is positioning itself as the hub for the latter. While Europe and the US rush towards CBDCs to control their populations, Singapore is building the regulatory playground for asset-backed tokens to attract money. They understand that money goes where it's treated best. By protecting token holder privacy and gold owner property rights, Singapore is betting the free market will win. So how do you build the ultimate portfolio using this knowledge? It's a tiered approach to freedom. Tier 1, deep cold storage, 50%. Physical bars in a private segregated vault in Singapore or similar neutral location. This is your catastrophic insurance. You don't touch this. It's for the next generation or when the entire power grid goes down. Tier 2, liquid digital gold 30%. Tokenized gold held in a hardware wallet, self-custody. This is your savings account. It's accessible, movable, and spendable, but outside the banking system. Tier 3, paper cash 20%. held in a bank for immediate bills and operating expenses. This is the sacrificial money that you expect to lose value. Keep only the minimum amount necessary to function. By moving from Tier 3 to Tier 2, you stop the bleeding. By establishing Tier 1, you ensure survival. The last safe haven isn't just a place, it's a strategy. It's realizing that where your wealth is located matters as much as what type of asset it is. It's understanding that in a digital world, physical ownership is the only true anchor. The billionaires moved their gold last month because they see the control grid tightening. They see capital controls, wealth taxes, and CBDCs coming. They've secured their exit. They've built their bridge to the new system. The question is, have you? The technology exists. The jurisdiction exists. The only barrier left is the old mindset holding you back. The window to act is open now. But as the crisis speeds up, the bridge from west to east will become a toll road. And then eventually a drawbridge that's raised for good.